Stand in any British town centre built before 1990 and you'll see empty shells of buildings that once housed grocery empires. Your parents queued in those shops every Saturday. Your grandparents thought they'd be there forever. These weren't struggling corner shops or risky startups. These were household names with hundreds of locations, decades of profits, and customer loyalty that seemed unbreakable, until the day they filed for administration and vanished within months, taking thousands of jobs and billions in value with them. We're talking about supermarket chains that dominated British shopping for generations before making catastrophic decisions that destroyed everything they'd built. 8 British supermarkets that went from success to total failure, and the brutal business lessons they learned too late. These collapses changed British retail forever, and what killed them is still killing businesses today. Let's expose the fatal mistakes.
Coming in at number 8, Budgens. Budgens operated a successful convenience supermarket chain for over a century, serving local communities with neighborhood stores before franchise model changes and ownership instability destroyed the cohesive brand. The business thrived for decades as genuinely local grocery chain with stores in villages and small towns too small for major supermarkets, building loyal customer bases who valued convenience and personal service. The shift toward franchising in the 90s transformed Budgens from company-owned consistent brand to loose collection of independently operated stores with wildly varying quality, ranges, and customer experience that confused and alienated shoppers. Former Budgens franchisees described the tension between head office demands and local realities, with franchise fees and required product ranges not making economic sense for smaller locations, creating resentment and inconsistent execution. The acquisition by Musgrave & Group brought resources but also shifted focus towards serving franchise partners rather than end customers, with the brand becoming vehicle for independent retailers rather than coherent customer proposition. The pricing became uncompetitive as franchise economics required higher margins than company stores, with Budgens becoming an expensive option compared to Tesco Express, Sainsbury's Local, and co-op stores that expanded aggressively into convenience sector. The failure wasn't dramatic administration, but rather slow decline into irrelevance, with stores gradually closing or rebranding as franchisees abandoned the Budgens name, finding they could operate more profitably under their own brands. Consumer research showed Budgens had lost brand meaning, with customers unable to describe what Budgens stood for beyond being a local shop that was usually more expensive than alternatives, demonstrating that franchise model destroyed the coherent identity that had made the business successful. The lesson from Budgens is that franchising can destroy brand value when it creates inconsistency that undermines customer trust, with short-term gain from franchise fees being offset by long-term loss of brand equity and customer loyalty.
Coming at number 7, Presto. Presto operated hundreds of discount supermarkets across Britain during the 70s and 80s, pioneering budget grocery retail before strategic confusion and ownership changes killed the brand completely. The business model of no-frills discount stores offering limited ranges at rock-bottom prices worked brilliantly in the post-war period when British shoppers prioritised value over choice and were willing to accept basic shopping environments for lower prices. The ownership by Argyle Group alongside Safeway created strategic confusion, with management unable to decide whether Presto should remain discount chain competing on price or be upgraded to compete with Safeway in middle market. Former Presto executives described the strategic drift as fatal, with the chain caught between discount positioning that required ruthless cost control and attempts to improve stores and ranges that increased costs without creating enough value to justify higher prices. The recession of early 90s should have been opportunity for discount retailer, but by then Presto had lost clear identity, wasn't cheap enough to be true discount option, but wasn't nice enough to compete with improving mainstream supermarkets. The decision to convert Presto stores to Safeway branding in 1995 eliminated the discount option entirely, with Argyle Group essentially admitting that Presto had become worthless and the real estate was more valuable as Safeway locations. The disappearance of Presto left gap in discount market that would later be filled by Aldi and Lidl, demonstrating that viable market existed, but Presto had failed to serve it effectively through loss of positioning clarity. Consumer research from the period showed Presto customers felt abandoned by the upmarket shift, with loyal discount shoppers losing their preferred option, whilst the improved stores failed to attract enough new customers to compensate. The lesson from Presto is that repositioning established brand is extremely difficult, with attempts to trade up often alienating existing customers without successfully attracting new segments, leaving business worse off than maintaining original positioning. Coming in at number 6, Low Cost. Low Cost operated as ultra-budget supermarket chain in the 70s and 80s with deliberately Spartan stores offering absolute minimum prices through radical cost-cutting that eventually made the format unsustainable. The business model involved stores that were barely more than warehouses, with products sold from shipping pallets, minimal staffing, no carrier bags, and absolutely nothing that didn't directly contribute to lowest possible prices. The success in the 70s came from economic conditions where high inflation in recession made British shoppers desperate for any savings, with Low Cost's extreme discounting attracting customers willing to tolerate basic conditions for meaningful price reductions. Former Low Cost employees describe working conditions that were harsh even by discount retail standards, with stores chronically understaffed, minimal training, and pressure to process customers as quickly as possible regardless of service quality. The ownership changes and integration into larger retail groups destroyed whatever operational efficiency had made extreme discounting viable, with corporate overhead and systems inappropriate for bare-bones discount format increasing costs without adding value. The rise of more sophisticated discount formats from companies like Kwik Save that offered better environments while still maintaining low prices made Low Cost's warehouse approach seem unnecessarily unpleasant rather than acceptably basic. The brand disappeared through store closures and conversions to other formats, with final locations closing in early 90s after 2 decades of serving price-conscious British shoppers. Consumer research showed that even very price-sensitive customers preferred shopping environments that weren't actively unpleasant, with Low Cost's success depending on customers having no better alternatives, which became untrue as discount sector evolved. The lesson from Low Cost is that sustainable competitive advantage requires more than just being cheapest, with businesses needing defensible positioning that can survive when competitors replicate the core proposition with superior execution.
Coming in at number 5, William Lowe. William Lowe operated successful regional supermarket chain in Scotland and Northern England for over a century before being acquired by Tesco in 1994, with the brand disappearing despite strong local loyalty and profitable operations. The business built excellent reputation in Scottish communities through genuine local focus, quality products, and customer service that created loyalty unusual in grocery retail, with William Lowe stores being genuine community institutions. The family ownership maintained long-term perspective and reinvestment in stores and staff that created sustainable competitive advantage, with employee loyalty and customer satisfaction levels that publicly traded retailers struggled to match. Former William Lowe staff described the business as genuinely caring about communities it served, with store managers having autonomy to respond to local needs and long-serving employees who knew customers by name, creating shopping experience that felt personal. The acquisition by Tesco in 1994 for £247 million was primarily about eliminating competition and gaining excellent Scottish store locations, with the William Lowe brand being secondary consideration despite its strong regional equity. The conversion of William Lowe stores to Tesco branding happened rapidly despite protests from customers and employees who valued the local character, demonstrating that Tesco saw no value in maintaining regional brand when they could leverage their national scale. The loss of William Lowe represented broader trend of regional grocery chains being eliminated by national operators, with distinctive local businesses being replaced by homogenized corporate formats regardless of customer preferences. Consumer research showed strong emotional connection to William Lowe brand in Scotland, with many customers continuing to resent Tesco decades later for eliminating a retailer they valued. But this loyalty wasn't enough to prevent acquisition when family owners chose to sell. The lesson from William Lowe is that even successful, profitable businesses with strong customer loyalty can disappear when ownership decides to sell to a larger competitor who sees value in locations and elimination of competition rather than preservation of brand equity.
Coming at number 4, B-Jam. B-Jam pioneered frozen food retailing in Britain with 300 stores at its peak, creating a successful business model before being acquired by Iceland and the brand eliminated despite having arguably stronger market position. The business model of focusing exclusively on frozen foods in high street locations served customer need brilliantly, with B-Jam building reputation for quality frozen products and excellent customer service that created loyal following. The ownership by John Apthorpe created entrepreneurial culture and long-term reinvestment that built genuine competitive advantage, with stores that were well-maintained, well-stocked, and staffed by knowledgeable employees who understood frozen food category.
Former BJAM staff described the company culture as genuinely valuing employees and customers, with training, career development, and empowerment that created motivated workforce delivering superior customer experience. The merger with Iceland in 1989 was presented as equals combining to create stronger frozen food retailer, but rapidly became clear that Iceland management saw BJAM brand as redundant despite it arguably having stronger customer loyalty and quality reputation. The conversion of BJAM stores to Iceland branding happened quickly, with the BJAM name disappearing within 2 years, despite having been household name for 3 decades, eliminating brand equity that had real value. Consumer research showed BJAM customers felt the Iceland conversion represented quality decline, with loyal BJAM shoppers perceiving Iceland as cheaper, lower quality alternative and resenting loss of retailer they trusted. The elimination of BJAM brand is considered by retail analysts as classic example of destroying value through unnecessary rebranding, with Iceland gaining stores but losing customer goodwill and quality positioning that BJAM had built over decades. The lesson from BJAM is that acquisitions destroy value when acquirers assume their brand is automatically superior, with BJAM having distinct brand equity that was carelessly eliminated rather than leveraged or maintained alongside Iceland for different market segments.
Coming in at number 3, Victor Value. Victor Value operated hundreds of discount supermarkets across Britain in the 60s and 70s as pioneering budget retailer before being absorbed into Tesco and the brand eliminated. The business model of extreme discounting through limited ranges, basic stores, and ruthless cost control created genuinely cheap shopping option for working-class British shoppers during period of economic difficulty. The yellow and black branding with cartoon mascot created memorable visual identity that made Victor Value instantly recognizable, with stores that looked nothing like traditional grocers, signaling their different value proposition. Former industry analysts describe Victor Value as ahead of its time in understanding that a segment of market valued price above all else, with the format predicting what Aldi and Lidl would successfully execute decades later. The acquisition by Tesco in 1968 provided scale and resources, but also began strategic drift, with Tesco management struggling to reconcile Victor Value's discount model with their own mass market positioning. The attempt to integrate Victor Value into Tesco's operations destroyed the cost discipline that made extreme discounting viable, with corporate systems and overhead inappropriate for bare-bones format, increasing costs without adding value customers wanted. The conversion of Victor Value stores to Tesco branding in the 70s eliminated the discount option entirely, with Tesco deciding that single brand was simpler than managing multiple formats, even though this abandoned a segment of market. Consumer research showed Victor Value customers felt abandoned by conversion to Tesco, with price-conscious shoppers losing their preferred option and Tesco's broader range and higher prices being unwelcome rather than appreciated. The lesson from Victor Value is that acquirers often destroy what made acquired businesses successful by imposing their own systems and culture, with discount formats particularly vulnerable because their economics depend on cost discipline that's antithetical to corporate bureaucracy.
Coming in at number 2, Hinton's. Hinton's operated as a successful regional supermarket chain in Northern England with particular strength in Yorkshire, building loyal customer base through decades of consistent service before being acquired and eliminated. The business model focused on serving local communities with stores that felt like neighbourhood grocers despite being part of larger chain, with staff who knew customers and understood local preferences, creating personal shopping experience. The family ownership maintained long-term perspective, investing in stores, staff and relationships rather than maximising short-term profits, creating a sustainable business that served communities well whilst generating returns for owners. Former Hinton's employees described the company as genuinely caring about people, with long careers common and store managers having real authority to serve their local communities rather than being mere implementers of corporate policy. The acquisition by Safeway, joint venture between Sainsbury's and British Home Stores, brought capital and scale but destroyed the local character, with corporate systems replacing personal relationships and cost-cutting eliminating the service that had differentiated Hinton's. The conversion of Hinton's stores to Safeway hypermarket format eliminated neighbourhood stores entirely, with Sainsbury's deciding that out-of-town big-box stores represented the future and local high street presence was irrelevant.
The failure of the Saver Centre concept meant that within years, the Hinton stores had been closed or converted again, essentially destroying successful business to pursue a strategy that didn't work anyway. Consumer research showed strong attachment to Hinton's brand in Yorkshire communities it served, with customers resenting loss of local retailer that had been part of their lives for generations, but this loyalty meant nothing once ownership changed. The lesson from Hinton's is that regional businesses with strong local positions can be destroyed by national acquirers who don't value or understand local relationships, with homogenization eliminating the very differentiation that made businesses successful.
Coming in at number 1, International Stores. Taking the top spot is International Stores, which operated as one of Britain's largest grocery chains with over 700 stores before catastrophic mismanagement and acquisition destroyed a century-old retail institution. The business, built over decades through acquisition of regional chains, created extensive national presence serving working-class communities, with stores in locations that major chains hadn't yet reached. The success came from understanding price-conscious customers and serving them competently with reasonable ranges, acceptable quality, and prices that represented genuine value without being absolute cheapest. Former International Stores employees described the business as a stable employer with reasonable conditions and long-serving staff who understood their communities, creating shopping environments that felt familiar and trustworthy. The leveraged buyout in 1972 by Cavenham Foods loaded the company with debt whilst extracting dividends, classic asset stripping that weakened the business financially whilst enriching new owners at expense of long-term health. The lack of investment in modernising stores meant International Stores fell behind competitors who were building bigger, better supermarkets, with the chain's smaller, older stores looking increasingly shabby compared to Tesco and Sainsbury's new developments. The sale to D Corporation in 1978 brought more ownership instability, with new management attempting various turnaround strategies, none of which addressed fundamental problem that the stores were outdated and the brand had become associated with decline. The conversion of International Stores to Gateway branding in early 80s eliminated a name that had been part of British shopping for generations, with the business essentially disappearing into larger corporate entity. The failure represented broader pattern where traditional grocery chains built during earlier retail era couldn't adapt to supermarket revolution, with ownership extraction and lack of investment accelerating decline, but fundamental obsolescence being the underlying cause. Consumer research showed International Stores had become place people shopped when they had no better option, with customers abandoning stores rapidly when Tesco or Sainsbury's opened nearby, demonstrating that loyalty was to convenience rather than brand.
Lesson number 2. Clear positioning is essential. The successful supermarkets that survived decades of competition maintained clear positioning that gave customers specific reason to choose them, whether that's Waitrose for quality, Aldi for price, or Tesco for range and convenience. The failed chains lost positioning clarity through attempting to be everything to everyone, with strategic drift meaning customers couldn't articulate why they'd shop there rather than alternatives that did specific things better. The middle ground between discount and premium is particularly treacherous, with chains stuck there unable to compete on price with discounters or quality with upmarket alternatives, hemorrhaging customers in both directions. The repositioning attempts usually fail because they alienate existing customers without successfully attracting new segments, with Presto's upmarket move and low costs moderating being examples of losing loyal base without compensating gains. The lesson is that maintaining clear differentiated positioning requires discipline to resist temptation to chase every segment, with successful retailers knowing what they are and ruthlessly staying focused even when other segments seem attractive.
The brutal lesson from British supermarket failures is that good operations cannot overcome bad ownership, with profitable, well-run businesses being destroyed by leveraged buyouts, asset stripping, and strategic incompetence from acquiring companies. The family-owned businesses like William Lowe and Bayjam maintained long-term perspectives, investing in stores and staff, creating sustainable competitive advantages that public companies and private equity struggled to replicate. The acquisitions destroyed value through eliminating successful brands, imposing inappropriate corporate systems, extracting cash through dividends and sale leasebacks, and pursuing misguided strategies that abandoned what made businesses successful. The lesson is that ownership structure determines ultimate success or failure, with businesses needing owners who understand the sector, take a long-term view, and reinvest in competitive advantage rather than extracting maximum short-term value regardless of long-term consequences.
So there you have it, 8 British supermarkets that failed after years of success, from Budgens destroyed by franchise inconsistency to Presto killed by strategic confusion, from low cost made obsolete by better discount formats to William Lowe eliminated despite success, from Hengham carelessly destroyed after acquisition to Victor Value abandoned by Tesco, from Hinton's eliminated for failed hypermarket strategy to International Stores destroyed by asset stripping and obsolescence. The common threads are loss of clear positioning, leaving customers with no reason to shop there, acquisitions that destroyed rather than created value, ownership extraction weakening businesses, failure to invest in modernization, and strategic decisions that abandoned what made businesses successful. These weren't inevitable failures, but results of specific mistakes that killed profitable businesses serving real customer needs, demonstrating that retail success is fragile and bad decisions destroy decades of built equity rapidly. The survivors maintained clear positioning, invested in competitive advantage, had ownership focused on long-term value creation, and adapted to changing competition while staying true to core proposition. Every failed chain employed thousands, served communities for generations, and seemed permanent until they weren't, with buildings that housed them still standing empty decades later as monuments to retail mortality. The lessons remain brutally relevant as current retailers face online competition, discount threats, and changing behavior that could make today's giants tomorrow's failures if they repeat the mistakes that killed these predecessors. If you remember shopping at these chains, you witnessed dramatic business failures that changed British retail. And if you're too young to remember, you're learning how quickly success turns to failure when businesses lose positioning, get bad owners, or fail to adapt. Thanks for watching, and remember that in retail, yesterday's success guarantees nothing, and the graveyard is full of brands that seemed invincible until the day they filed for administration and vanished.